As elections loom, the Turkish economy is facing a self-inflicted economic crisis of high inflation and a cost of living crisis that dwarfs what we see elsewhere in Europe. In recent years, Turkey has seen a surge in inflation to over 80%, leaving over half of people in Turkey unable to meet their daily expenses. Yet, as we shall see, this is largely a self-inflicted crisis from the unorthodox policies of the government, a reminder of how political short-termism can have devastating effects. Why did things go so wrong in Turkey, and how bad might they get? In the past 20 years, Turkey's economy has posted some impressive economic growth figures, causing many to experience rising living standards and providing a base for Erdogan's electoral support. However, from 2018, the strong desire for higher growth caused Erdogan to ignore the advice of economists and pursue a very unorthodox approach to the economy. Rather bizarrely, President Erdogan blamed Turkey's high inflation on high interest rates. He claimed that high interest rates only make people poor. Ignoring advice, he sacked 3 central bankers and effectively ran the economy by personal diktat. But the economic effect of cutting interest rates at a time of inflation was to predictably further cause inflationary pressures. And as he explained his new economic policy on live TV, it led to an immediate slide in the Turkish lira, once falling 15% during a single TV address. This sharp cut in interest rates, well below the inflation rate, gave Turkey the cheapest borrowing costs of anywhere in the OECD. This led to stronger investment and higher consumption. However, this increase in borrowing and cheaper money only caused a further rise in inflation, and this inflation was devastating for the middle class, with workers shocked to see grocery and energy bills doubling in a short time. To put it into context, Turkey's inflation is like the UK or US's inflation, but at least 10 times worse. The result is that savings are quickly being eroded and wealth evaporates, leaving a trail of uncertainty and confusion. When inflation is so high, it also leads to other costs, with frequent haggling over prices and supply contracts. Now, in response, the government have increased the minimum wage and pensions, but although seemingly generous, they themselves were soon eroded by the high inflation. President Erdogan claimed that high interest rates hurt the poor the most, but the truth is that it is really inflation that really damages the well-being of the average worker. Big business and the better connected have been able to insulate themselves to some extent by holding foreign currency reserves or buying tangible assets such as land and property. But for many poorer workers, this hedge against inflation is not viable, and instead workers are struggling to pay their bills and getting into debt. Goods that were once seen as basic items have become almost luxuries. The super high inflation has also led to a brain drain, with the most skilled workers seeking better conditions and stability abroad. The very high inflation has had a predictable effect on the Turkish lira, causing a rapid devaluation in the value of the currency. And as the currency weakens, this pushes up the price of imports. And for an energy importer like Turkey, this has been devastating, especially at a time of rising oil prices. The result is that it's made Turkey more dependent on cheap energy from Russia. Due to its dire economic situation, Turkey has not taken part in sanctions on Russia, but continues to buy Russian oil and coal at a discounted price. But Turkey's problems get even worse, because it also has a persistent current account deficit, which means it's a net importer. This reflects both high consumer demand for imports and also its poor industrial competitiveness due to the high inflation and its underdeveloped exporting sector. The Turkish government hoped that its policy of cutting interest rates and devaluation would enable it to emulate China's economic miracle of strong export growth. However, this has been a real failure. In a period of high inflation, the benefit of a falling currency to boost competitiveness tends to be very short-lived. Economist Kevdet Akay explains that exporters in Turkey have become exchange rate addicts. They were ecstatic at first, but now they're complaining again. This is a problem of relying on devaluation to improve exports. It's only a very temporary solution, and it doesn't address the underlying productivity. Turkey also has a growing external debt, money it owes to other countries, and this has become increasingly difficult to finance because the devaluation has increased the effective cost of foreign debt interest repayments. The large Turkish current account deficit also means it needs to attract capital flows to finance the deficit. Turkey needs to find approximately $200 billion a year to fund its current account deficit and maturing debt. But after attempts to shore up the currency by the central bank, the state only has very limited foreign currency reserves of just $85 billion. And this has made Turkey vulnerable to relying on credit from energy producers like Russia and Qatar and Saudi Arabia. Last year, Turkey received $25 billion in informal funds, i.e. mostly credit from Russia. But this is clearly unsustainable in the long term. Turkey has been trying to tread a fine line, the meeting point of East and West, attracting the best of Europe and Asia. However, Erdogan's increasing authoritarianism, high inflation, falling currency, and perceived closeness to Russia has made Western firms more reluctant to invest in Turkey, which doesn't bode well for the long term. The result of all this is the classic signs of an economy vulnerable to capital flight, devaluation, external debt, and weak economic growth. But the fear is that Turkey could end up defaulting like Sri Lanka did recently. One strategy Turkey has toyed with is to be a hub for reselling Russian coal, oil and gas. In theory, Turkey can buy Russian oil at discounted prices and resell it to the rest of Europe. But Europe is increasingly committed to a long-term rejection of Russian energy and finding alternative sources. And the recent falls in oil and gas prices have eased the crisis in Turkey, but also made the EU's plan to move on from Russian energy much more realistic. Now, despite all these economic problems of inflation and devaluation and higher living costs, we might be surprised to see current economic growth in Turkey is quite high. Well, there are a number of explanations. Well, the whole point of an ultra-low interest rate policy is to provide a temporary boost to consumption and investment. It's very cheap to borrow and this encourages spending, and so we get this short-term boost in growth. Secondly, when inflation is so high, and inflation is eroding the value of your money, Turkish consumers might as well spend it as soon as possible because it only loses value. But the problem with this high consumption is that it's simply not sustainable in the long term. It's like a sugar rush of energy from eating sweets. It provides a rush of blood sugar, but when the injection expires, you are left with low energy. The usual after effect of this kind of artificial consumption boom is a painful readjustment and recession. It is somewhat reminiscent of the 1980s Lawson boom in the UK, where high confidence and rising asset prices led to a boom in consumption, current account deficit and higher inflation. But the hangover from this supercharged boom was of course a painful recession. In the short term, Erdogan is running the economy to give the highest growth for the upcoming election. But the failure of the economic strategy is that the inflationary growth has imposed very significant costs on many potential voters. But the real problem is that after the election, there's likely to be a reckoning, as the high levels of consumption cannot be maintained given the very high levels of inflation. So this episode highlights the problem of an autocratic leader running the economy on personal whims without taking independent advice. When you are used to controlling the narrative, it's easy to think you can pursue any policy. But the laws of economics cannot easily be changed. If you cut real interest rates to minus 20%, there's going to be an inflationary impact, whatever your views on the morality of high interest rates. It is one reason why we have an independent central bank. It reduces that temptation for politicians to pump prime the economy just before an election. But what happens next for Turkey? The Erdogan government have effectively given up on inflation. But relying on low interest rates to boost growth is at best a short-term policy, and there is no evidence it's led to a long-term investment. And of course, on top of all these problems, the devastating earthquake earlier in the year could cost up to $80 billion, or 10% of GDP, to repair. To reduce inflation will almost certainly require higher interest rates and an economic slowdown, and it will be a painful process. The only silver lining is that Turkey has had periods of inflation before, and despite all the current costs, has a strong entrepreneurial spirit for maintaining business despite these problems. But the current inflation is a very real problem for the majority of Turkish people, reducing living standards and damaging long-term prospects of the economy, and it could prove pivotal in the upcoming presidential elections.